Per usual, living on this channel for educational purposes only and is not intended as financial advice. It's Teaching Tech Tuesday. Let's talk about chart patterns. Definitely one of my favorite parts of technical analysis. Usually very simple, usually very obvious. The more obvious these patterns are, the more obvious they are generally to the market. If they are wishy-washy all over the place, the less conviction they have, the less obvious they will trade. The bias will be a coin flip, and it'll just be all over the place. Ideally, what you always want to see is a horizontal line. Diagonal lines for support resist for the market can be very confusing, and we can look no further than the current pattern. We have a series of lower highs, a series of lower lows. Where do you draw the line? What does it mean? Do you use the wicks? Do you use the bodies, right? This is in aggregate what people are asking when they look at stuff like this, versus even this March to September pattern, which to me looked cleaner, had a much cleaner neckline, had a much cleaner breakdown. It did not go fully bearish, but it did break down. That looked and felt and played out much more obvious than this might. So we're going to talk about how to tackle this as a chart pattern, what to look for, what to trade. And we've had a few wedges over the past couple years. Even on ETH, we had a wedge before the breakup, before March of this year. But we even had a wedge down here. We had a wedge all the way back here in the SVB area. We had a wedge potentially in like the COVID low of 2020. I don't think we've seen a wedge of this duration in quite some time. So first things first, identifying the pattern. It's always good to have a master list of the most obvious patterns that we see on a day-to-day basis. Are they reversals? Are they continuations? Are they 50-50? That usually comes with time to understand exactly what most of this stuff is. Generally, any patterns that are falling typically break up. Any patterns that are rising typically break down. So if we look at this one, we are falling. As bearish as this is and feels, it's certainly better than a rising wedge. It's certainly better than a closing wedge versus an expanding or broadening wedge. So we'll take it. This isn't obviously bearish here. So I'm not treating it as such. This isn't a rising wedge. This isn't a reversal pattern up here at the highs, at all-time highs. Not exactly a bullish rectangle either. It's not flat, right? There's no horizontal lines here. Not a bullish pennant. This is expanding. So it's none of this stuff. It's nothing really on this chart, but this will give you some clue as to what these patterns may or may not be. And it's nothing on this chart. So you got to keep looking, right? Okay, so let's talk about wedges. Different types of wedges. There's megaphones, there's broadening, expanding, descending, right angled. And when you're going into this and you don't really know what you don't know, it's always a good idea to just get a lay of the land. Now we're getting closer. We're getting warmer. This is an ascending broadening wedge. This is on Bulkowski's website. He is the chart pattern king. He's got all sorts of data and backtesting on this in Legacy Land. But this is the closest of the wedges, and this is probably what this is. It's probably a descending broadening wedge, and you can read on what this might be. It's a megaphone tilted down. We can look at how this breaks up. Can be up or down. Okay, great, thank you. Average rise, average decline, throwback, pull out, right? He's got all this data here, and he tells you right off the top that it is a low ranking pattern as far as probabilities. So that should automatically get your alarm bells ringing that, hey, I don't want to go full bore on this thing until I'm sure. I don't want to size up. I don't want to leverage up. I'm just going to wait. And back to what this is, that's what the market is doing. The market has no clue. One day it's up 5%, the next day it's down 10. The market has no clue what's going on here. There's a lot of people still selling, waiting for our tailwinds to pick up, hopefully, assuming you think this is bullish like me, and we will revisit the highs. But just knowing that this pattern specifically, not the best for performance based on his numbers. This isn't a megaphone either. It's not expanding at the top and the bottom. It's making lower highs. It's not broadening on the top or the bottom, right? So it's none of those things really, and it's not right angled either. This might seem wishy-washy, but it's important to first identify what this is, because then that leads you down the road of, okay, what is the performance ranking and what are the numbers behind patterns that typically look like this? And we just had one of these the other day that broke down, right? So again, if we had a horizontal up here, that would make it a little better. And depending on how you want to draw this, you could interpret it with a horizontal. I just don't think that's what the market is necessarily seeing here. Before I go any further, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures, Inc., PVI, DBA, Kraken. We've actually had quite a few wedge type moves, even in Legacy. I'll get to PAX-G in a second. But even stuff like this, Ripple here, I'm bringing it up because it's for the video. It's all the same decision process. What are we looking for? What do we want to see if we have a bias? If we have a long bias, it's very obvious to me where we want this to go to be sure that the breakout is real. Now you can always turn on volume. I'm not a massive fan of volume because the exchanges are very fragmented. The volume across the exchanges is very fragmented. You sort of have to use an index. Are we talking about US hours, Asia hours, Europe hours, right? There's all sorts of issues with volume. But if you're looking for something on volume, you always want to see a massive jump in volume once we are sure that we made the breakout, that we happened to cross over, in this case, 66 cents. So what would I expect down the road here on this chart? I would expect a massive jump in volume at 67 cents. If we don't see that, it doesn't mean it's a failure. It doesn't mean it's all over. It just means your confidence, my confidence in the breakout potential goes down. It's just something else in the checklist to watch. Looking at PAX-G, you could have interpreted this most recent move. We go back, dial it back a bit. This is gold. If you wanted to, you probably could have interpreted this as some sort of wedge that it's still kind of in. This may not have been the best interpretation, which is why I like this interpretation, inverted head and shoulders, rising inverted head and shoulders. And even if you're wrong about the pattern per se, at the very least, it gives you some idea of what to expect at certain levels, what to expect at 22 versus this diagonal on the way up. So back to BTC right now, you could interpret this as, I think this would be a right angled descending, right? It doesn't matter. We can go down the weeds on nomenclature. But I know how this should work. This should, in my opinion, be bullish. We saw one of these on Link. I'll talk about that. So the first thing I always do, add the lines. I'm on log scale. The next thing I do is add the fibs. You can go on the top left, fib high to the low. It gives you the levels. My fibs might look a little different than yours. I am using this fib levels based on log scale all the way at the bottom of the fib settings. Okay, once we have this all drawn out and mapped out, something else you can add is just the width of the pattern measured higher from the breakout. This is using the maximum, including the wicks. You want a conservative estimation and you want a liberal expanded estimation, because again, this gives you a zone at which you can take action on the breakout, assuming we get there. While this is making its merry way higher, potentially, we may see something like this. It may break out, it may come back, and then it may take us into Q4. Eventually, it may start to live in the 90s, below 100. It may pop above that for a day or two, whatever. But you want to be ready with a plan way ahead of time. You should know today what you're going to do in Q4. Trying to figure out what this pattern might be helps me do that. Some people might think I'm crazy, but using this schematic, you can say, okay, where am I going to add? Where am I going to add? I love ads anytime above the cloud. This was wrong. This was wrong. It was wrong so insofar as it didn't go anywhere. Okay, right? But I don't care. New trade, next trade, next trade. Anytime we're above the cloud, I'm adding. Okay, that's one thing on the checklist. We get a 1050 bull cross, I'm adding. Okay, we can write these down and we can say anytime we are meeting these conditions, we are adding. Here's a 5200 cross. This may be a little late, honestly, but put it on the list. 5200 cross, great. Anytime we're above that, or we've crossed, made a bull cross, I'm adding. Here's the 20-week moving average. Anytime we're above that, I'm adding, and you'll notice that this sort of matches the cloud a little bit. So on top of whatever mess this might be, You can still use trend metrics. You just have to realize that this is not really trending, but you can use trend metrics to help you gauge strength within the chop. So above the cloud, 1050 cross, 5200 cross, above 20-week moving average to 140. Or whatever you want. Turn on the alligator. Do I have the alligator here? Turn on the alligator. Another cross to watch probably matches the cloud most of the time. It's the 5813. Let's say we break up. That's another reason to add. But what I wouldn't do here is just assume we're bullish. I'm going to go all in and just wait. My stop loss is here, 49. Your stop loss is the bottom of the range, and it might bounce at 49. Any further adds I'm doing here, current stop loss would be a lower low at 56. Then you'd have to reevaluate sub 50, depending on how it looks if you want to add. The difficulty here with the stop loss is this wick is so large. You really don't want to stop yourself out at 49. If anything, you want to stop yourself out at the body of the daily candles, which would be 54. You always want to give yourself the optionality. Where's the point of no return, right? It's going to be different for everybody, but I like stop losses here at this low, and I like stop losses at the body of the huge move down. But ultimately, I'm out at 56 because we should not be revisiting that if we actually have strength here. Okay, so stop loss at 56, stop loss at 54. We know our ads based on trend metrics, cloud, 1050, alligator, whatever you want to do. It's up to you. And as a breakout, you can also just say, you know what, I'm going to wait. I'm literally going to wait until we are at 72 on a daily close. Otherwise, don't even talk to me, Josh. I don't even care. Let this chop around. It's just too much for me. That's fine. You can do both. You can say, I want nibbles. I want to just add a little bit here and there based on any strength. But ultimately, I want to shove all in at 72. We can also add volume on this, which this is the index on TradingView. Ideally, in any consolidation, you are seeing declining volume, which isn't necessarily the case here. But on the breakout, let's say we move above 72, you most certainly want to see a local high in volume, whatever that might be. So that's something to watch down the road. I know a lot of people are sticklers about what patterns are and where they can form and watching volume. You can always be hyper specific and make zero trades. That's totally fine. Or you can just, give yourself some wiggle room. If we're more bullish, I'm going to add a little bit here. If we're less bullish, I'm going to get stopped out here. That's probably a better way to go about this. Just because Bitcoin can be plus or minus 5% for any reason on any day of the year. So you have to give yourself that optionality. Even if we look on the low time frames right now, if we were bearish and I was seeing this, I would say, that's weird. This is reminiscent of an attempt. This is the hourly, it's low time frame. It's reminiscent of an attempt to move higher. Fits my bias, right? Great, cool. But if I was bearish, I would have to question what's going on here. The same is true if I was bullish and I was seeing the opposite of this, or a rising wedge on low time frames or something, right? That would make me question what's going on here. But that goes back to using first the daily cloud, always. Anything above that, we're adding 1050 cross bullish, we're adding alligator, right? Whatever, use whatever you want. 50, 200, we're adding. Because what I really don't want to do, I don't want to add everything back at 72 or go max leverage at 72. I would much rather assume, based on macro conditions, this is probably going higher eventually, and just get ready for it. So whatever comfortable percentage of the allocation is up to you, but trading anything down here, low time frames, seems quite silly to me. And if this breaks out, as it breaks out, you can look at Williams fractals for trailing stop losses, much like we did all the way back here. This was the inverted head and shoulders. That was your breakout on this day exactly right here. This is where you want to be max long. I was even adding back here a little bit as I was pretty sure what was going on. So you want to be max long on this candle. Let's check volume. Volume was slowly starting to break out, and it might be easier to see this on lower time frames, but the volume wasn't too impressive. It was a slightly higher high in volume, and it didn't quite matter. So again, you want to be flexible here. You don't want to say, if we don't see this, I'm not doing anything. You want to say, I'd rather see this to do more, but if we don't see that, I'm not just going to sit on my hands and do nothing. I mean, if we get to 72 for the first time in a month, for the 16th time in 6 months, yeah, it's probably a good time to do something. Anyway, back to fractals, Williams fractals. I talk about these a lot, but just real quick, as the breakout is happening on the daily or the 12-hour, it's up to you which time frame you use. I'd focus on a higher time frame. As a trailing stop loss, you don't want to see anything below the support fractals. You don't want to see a single close. If we get a single close below a support fractal, you're out. That's how this works. Each successive fractal replaces the previous one. So in this case, the stop loss is actually moving down. And you want a close below the stop loss, not a wick touch, not a dance around the level. You want to close below that level. So we did not get that here. This is perfect. I would love to see this at 72K because you even get a little mini high and tight continuation flag. And if we copy the bars just to try to get some idea, it should be a similar type of move, in which it is, depending on where you want to put this. So it's not out of the ordinary that we see something similar again on the breakout. But Williams fractals are really great on the trailing stop loss. So we've got our entry, we've got our exit, we've got our trailing stop loss plan. After the breakout, I would not look or think about looking at fractals here. As you can see in the range, they are useless. They're giving you signal after signal after signal. That's not what they're for, at least how I want to use them. I want to use them past 72, okay? So we know where we're adding, we know where we're subtracting, and that should be your plan. Whatever it is for you, I want to add above 63, I want to add every day above 63, whatever it is. But the last thing you want to do, the last thing you want to say to yourself is, you watch this thing consolidate for 6 months, 8 months, whatever, and then come 73K, potentially, we see in the future, you're hemming and hawing about what you should be doing and questioning what you should be doing. That is a recipe for disaster. The same on the lows. You do not want to be at a place where we're sitting at 50K wondering, what should I do? You do not want to be there. Pretend we hit 50K tomorrow. What would you do? Plan it out and get ready. If we want to measure the bearish case, depending on where this breaks down, that would bring us sub 40. Okay. It's on the table. It's not, I don't think, a reality. I don't think that's where we're going to go. I think that would basically be the 200-week moving average down there at 38. Not just because I want number go up, but patterns like this historically have broken up. And we can look at other versions of this. This is the SVB megaphone, a type of wedge. Not this type of wedge. This was definitely symmetrical. Very hard to trade. And the earlier you identify stuff like this, the better. Now, if we go back to like November, December, clearly in inverted head and shoulders attempt and Adam and Eve breakout, that's a lot cleaner than this whiplash back and forth, right? This was even the megaphone. I think we were talking about this before the breakout in February. ETH had a similar pattern. It's always good to see a reconsolidation at the breakout level. So I wouldn't be surprised if we see something similar at around 70 to 72. If we get back up there, that would be a very good sign for potential continuation. So that's something to think about in the future. Even 2019 into 2020, I don't think anybody was calling this a wedge. I was calling this an inverted head and shoulders, but it's always the same story. You get your initial breakout, usually you get a retest of the neckline, and that doesn't really change the expectation. If anything, it acts as a confirmation for bullish continuation. And this measured 18 to 27. We went way past that. So we do see these on occasion. Here was one with Link. This one took over a year and a half to break out. And you will always notice this on the trend metrics. The trend metrics, no matter what you're using, moving average, cloud, whatever, they will never lead you astray. More likely than not, the trend metrics will be on your side once the breakout is ready. If trend metrics are totally back and forth every day, bump the time frame up. Go up a time frame. Do not go down a time frame. Looking for what to do. Go up a time frame. Clearly, we were above the cloud. This is what you'd love to see for BTC. If we get a break here back to 72, even a bounce back down potentially to 62, 63, whatever, right? It could continue to look gross into Q4. That's why we're nibbling. That's why we're adding a little bit at X level in the low 60s if we see that. And we're not just 100X longing 60K. this could still take a lot of time into Q4, even past the US election, which is November, right? So you have to give yourself time and room to play that into October, throughout October into November. So we had the link breakout that played out excellent. Again, you're getting this consolidation post breakout. And even this, you could interpret potentially as some sort of descending wedge for the breakout there. This is probably the strictest interpretation. And does it really matter? Does it change anything at all? Not really, other than just what is the bias. Obviously, this is a bearish channel. It is going down and not up. But does it change anything if we get back to the highs, at least in my book? No. I'm not trading this as a range. I'm expecting this to break out, right? So it doesn't change the measured move. It doesn't change the expected resistance points. Nothing changes if you interpret this with a flat top versus diagonal, really. I mean, you might get in a little sooner at, let's say, 66, 65 instead of 72. That's why we're using a little bit of everything, right? A little bit of cumin, a little bit of paprika, a little bit of cayenne pepper, a little bit of everything to try to figure out what this may be as it's breaking higher. And of course, we have this option. We have the option of this whole thing could just be a mega cup and handle. That's not out of the ordinary to see that. We were talking about cup and handles in 2015, 2016. Very similar idea where post bear market recovery, we would shop around at previous all-time high, and then that would lead to bullish continuation. So this is where I want to get out of spot positions into 2025, potentially 2026, depending how long it takes. But obviously you're using trailing stop losses on the way up, cloud trend metrics, all that stuff. But this could be very, very real. And again, you don't want to mess that up and ask yourself what you should be doing at 73 if we could see a pretty crazy move, a bull market terminus, 200 plus, 333, whatever that is at the top there. And we saw something similar like that. If you look at gold, again, it helps to understand that this stuff happens and has happened and isn't exactly that crazy, because what do we have on gold here? The entire handle of a similar move on gold was an inverted head and shoulders. And that took a decade to play out. Gold happens much slower than BTC. So no matter what you think this might be pattern-wise, I personally think it's some sort of descending, broadening wedge, whatever, okay? Whatever you think it is, have a plan, write that plan down, look at charts once a day, once a week, don't deviate from your plan, and take action when you agreed to yourself when you would take action, because the last thing you want to do is lull yourself into complacency here and then just do nothing. Do nothing at 72, 73, 74. If we go that high, or 50 or 40, whatever it is, you don't want to be that person just looking at the chart thinking, oh my God, what do I do? What do I do? What do I do? Right? Have a plan, execute that plan, and be ready to go. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.